The U.S. nuclear energy sector is going through one of the most innovative and transformative times in our history. We're seeing advanced microreactors work towards the market.
This remote site in eastern Idaho could soon be the birthplace of a new nuclear age.
The reprocessing and refabrication of highly radioactive fuel.
Amazon has become the latest tech company to look to nuclear power for its energy needs, with the purchase of a $650 million nuclear-powered data center in Pennsylvania. Following on from last year's announcement that the company was investing in natural gas fuel cells to power some data centers, this latest purchase is yet another example of tech firms looking to secure their access to energy. It's also the second recent signal of a growing commitment to nuclear power from big tech, with Amazon following Microsoft as some of the world's most valuable companies now look to secure their ever-growing energy needs which have become exacerbated by the power-hungry demands of the nascent AI revolution and concerns over the reliability of the existing grid and inconsistent government policy. Microsoft's plans to enter nuclear energy production were revealed after the company placed a job posting for a nuclear technology role, tasked with overseeing a global small modular reactor and microreactor strategy. The news follows record investment in nuclear startups in recent years, with tech billionaires Bill Gates, Jeff Bezos and Peter Thiel all putting their money behind nuclear power. But the move from Microsoft may also signify a realization that dysfunctional Western energy policy will not be able to provide the power-hungry AI chips and data centers with the energy they need, with big tech choosing to invest in new nuclear projects when their own governments will not.
Coming up today, investors buy the dip, jobs report beats expectations, where new jobs are really coming from, the changing Fed tone, the Tesla drama, gold hits new highs, the takedown of another crypto king, and the changing face of the energy industry thanks to AI, and why this commodity bull market is just getting started. Well, it looks like investors helped themselves to a little buy the dip today. S&P 500 closing up over 1% with a little bit of a revival happening up the front here. Still got the Nasdaq, Dow and Russell underneath the 20-day with volatility, yields, oil, gold and energy green across the board, and joining them today was industrials. All other stock sectors still in short-term downtrends, and so it's still a little early to say whether this bearish engulfing candle is going to play out and take us into a 5-10% correction for the first time this year. And it's not unusual to get these retracement candles after we get these big engulfing candles. And for those of you who don't know, engulfing candle, typically when we gap up, take out the prior day's high and finish below the prior day's low. And that candle is engulfing the previous day candle. And the last time we saw a big bearish engulfing candle was actually in late July last year. And that too had two retracement days, almost coming back up to the high before the S&P 500 fell over 10% over the next 3 months before we found a bottom thanks to Jay Powell. It was a similar story when the market found its bottom after the bear market in 22 did a huge bullish engulfing candle on the 13th of October. I'll never forget that day. The price action on it just stuck out like a sore thumb. So many stocks and sectors on that day did this big bullish engulfing candles. And then the next day, we actually got a hard pullback. The market was down 2.3%, and it kind of makes you think, like, what was that? However, like I said, it's common for these engulfing candles to kind of retrace. And so it's still possible that we could see the same thing here, because we didn't get a large crush in the VIX for a Friday, especially after a big pop-up in Thursday. Did crush a little bit up the front after the VIX 1 day. Shot up heaps yesterday. However, interesting, VIX 3-month and VIX 6-month actually finished the day higher, with volatility risk premium still a healthy 6.3 points. In other words, option dealers still pricing in a bit of volatility ahead. But stick with me, because I'm going to take you through some news, research and data, and I've got some interesting charts I want to show you a bit later on. So apart from next Wednesday, when we'll be getting a look at inflation figures for the month of March, with the CPI coming out, the second most impactful economic print we get is the jobs market, the first Friday of every month. And I'm sure you all heard that came in a lot better than expected. Unemployment rate dropped to 3.8% from 3.9%, and a whopping 303,000 new jobs were added, well above the forecast of 210,000. And there's a chart of the monthly job gains for the US economy. And one can argue over the last half year is in a well-defined uptrend of higher highs, and even over the last year, one could say that is indeed in an uptrend. So it clearly shows the labour market and the US economy are still going strong. Things are accelerating. The country's near full employment. Everybody's got a job. Government spending like crazy. It is happy days. However, looking underneath the hood of the US labour market, it may not be all that it seems. What you're looking at here in the blue line is the amount of jobs held by native-born Americans, and that's actually lower than just prior to COVID. currently somewhere around 107 million, whereas it peaked out before COVID, a little bit above that, about 108. However, looking at the amount of jobs by foreign-born Americans, that's actually skyrocketed since prior to COVID, now approaching 140 million. And that shows in that time both the influx of legal and illegal immigrants into the country. And actually just looking at the year-over-year change in full-time jobs, that's actually down 284,000, whereas part-time jobs up almost 1 million. So in other words, jobs market looks good, but there's a lot of immigrants with multiple jobs. And interesting, looking back in history, this chart's a little blurry, but what you're looking at in the blue line is part-time jobs, and in the red line, full-time jobs. And normally we see a divergence between part-time and full-time jobs in recessions as people are picking up any types of work that they can. However, we don't have a recession at the moment. We've got a strong economy. Also underneath the surface, even though we have a fully employed economy, the disparity and gap between the haves and the have-nots continues to widen to record levels. You can see that in this chart, showing that the top 10% own 10 times as many assets as the bottom 50%, with the bulk of that held in equities and mutual funds. And this chart just shows right here kind of the decimation of the middle class over the last couple of decades, largely thanks to the Federal Reserve keeping interest rates rock bottom and flooding the market with trillions and trillions of dollars of liquidity and new money. And so the goal of investing for everybody is to increase your wealth and thus by extension your standard of living at a faster clip than inflation. If not, then you're on a path to zero, as inflation will eventually eat up all of your purchasing power. And that's why to not only protect your wealth, but to grow it, you have to participate in asset price inflation. You have to be in the market. Long-term cash is trash, and there's actually more risk of not investing, especially at times like now, when we're all hoping inflation would just dance back down to 2%, just like Jay Powell's been telling us, and we can just all forget about the trillions of dollars in artificial liquidity that's been pumped into the system over the last 15 years. However, that's not the case. Inflation could very well make a meaningful 70s style comeback in which the price for all of our products and services that we pay for start increasing at a faster rate again. And we're getting a little bit of a changing tune coming out of Fed members as well, with Dallas Fed President Logan saying it's much too soon to think about cutting rates. She's actually worried about the upside risk to inflation. Going on to say, while the benign path back to price stability remains possible, I see meaningful risks to continued progress. And the bond market's appearing to agree with her as well, getting another pop in yields today, back of that blowout jobs report, right across the curve as well. 2-year up 10 basis points, pushing up against resistance at 475, and even got the 10-year looking to break out again. Now going into the weekend at 4.4%, and thus causing a bit of weakness in the bond market. TLT now pushing down on this support zone we've got here, and high yield bonds kind of still hanging in there as well. So normally higher yields are bad for the stock market. However, that hasn't been the case today and the last couple of months, as the market continues to reprice when the Fed will start cutting rates. And it could be a case of the stock market actually starting to make sense. Instead of bad news is good news is bad, it could be a case of good news is good. It's liking the fact that the economy is strong and growing, plenty of people are employed and spending money. Because not even a material change in the Fed fund futures today, now completely flipping from just yesterday, 65% chance the Fed's going to cut in June. Now there's actually better than not chance they won't cut. We're just witnessing right now in front of our eyes the market pushing out to the end of July when the Fed's supposed to start cutting rates. And if you remember back to the start of this year, the market was initially forecasting March, and we've just kept pushing it out, and the stock market has just kept on rocking, doesn't even really care. However, some bulls are still hanging hope that we're going to keep seeing a strong economy and the Fed cutting rates, and saying that the S&P could soar another 26% by the end of next year. With research firm Capital Economics saying this stock bubble is nowhere near levels seen in 1929 and 2000, suggesting further upside ahead, and saying the Fed could cut rates more than investors are anticipating. And for here and now, they definitely have history on their side, because whenever the S&P has a Q1 return greater than 10%, whilst we can see a little bit of weakness in Q2, being positive only 72% of the time, going forward the final 9 months of the year, the last 3 quarters are positive almost 91% of the time. And whenever we're positive by more than 10% in Q1, we're always positive for the full year. And this is outside of election year seasonality. That is very bullish as well. So we could see a bit of weakness here in April going into May. Shouldn't be that surprised to get a 5-7% correction at some point. However, the forecast, I would say this year should be somewhere around a total return of 15 or so %. However, at the moment, tech and growth stocks gotten a little soft. Quite a few have lost their 50-day VWAP, and we can see that in the Vanguard Growth ETF, kind of tracking sideways for about 6 weeks now. We've lost trend, and same deal with the Nasdaq. actually closed yesterday underneath the 50-day VWAP, and most important stock Nvidia, still a bit off its highs and hasn't been able to close above $1,000 a share just yet. However, still way too early to say that Nvidia has topped. Still plenty of trend there. Could easily be back at $1,000 a share in no time. But what's really changed in this market, especially over the last month, is the outperformance of energy and commodities over tech stocks. We can see starting the year, the rolling 12-month returns between energy and tech stocks was 52%. And that gap has significantly closed in, now sitting at 23%. And just drawing in a line on the 1st of last month, you can see tech underperform and energy coming back to life. Not only energy, but also commodities. And it's not only oil and energy stocks riding up, it's also the precious shiny metal known as gold, hitting another all-time high today. And we can see that on the chart here, up a huge 1.6%, which for a normally low volatility, sleepy asset like gold is quite a big move. And we can see that in the trend strength at 29 on a really strong momentum rip here, along with its smaller brother of silver, looking really good on the chart. We have got trend and momentum thrusts on top of the whole commodity market starting to get back to trend. And so it's pretty interesting because we've had bond yields rise over the last month. The market price in less Fed rate cuts further out. Normally that's bad for gold because gold kind of competes with bonds, and the less interest bonds pay, the more attractive gold becomes in theory. However, like we just saw on the chart, gold's ignoring bond yields. It's kind of gone out on its own. Same with the dollar as well. So what sort of message is gold sending us right now? Well, there's good reasons for gold's rise. Not just in perception and sentiment, but actual underlying buying of the physical. For what is now the world's largest buyer, China's central bank. They've gone on an absolute buying spree as they're determined to get more of their reserves out of US dollar assets, treasuries, into gold, as not only a pursuit of de-dollarization, but what could also be a way for them to evade future sanctions if they were to go into Taiwan and trying to take away the US's leverage, in which the US government regularly uses its US dollar reserve currency status to lever sanctions on countries that don't comply with its requests. That's why we've seen China add to its gold reserves for the past 16 months in a row, purchasing last year 225 metric tons. It's roughly a quarter of the 1,000 tons bought by all the world's central banks. And not only do we have record buying of gold from BRICS nations, probably a lot of big institutional investors doing a bit of flight to safety with geopolitical tensions. Now we'll have the CTA managed futures industry, trend followers long gold as well, and every other investor is starting to jump on board. This comes at a time when we've still got record low valuations. What you're looking at here is a chart of the historical price to net asset value for North American gold miners, with a long-term average since 1985 at 1.49. Here we are today at 0.9. Also at a time when assets under management in gold ETFs still well off their highs from October 2020, 3,900 tons. Last print we got 3,100 tons. And there's a look at the gold mining ETF GDX, looking really good on the daily chart here. Plenty of trend, and believe it or not, still well off their all-time highs from 2011, significantly underperforming the underlying metal. However, by the looks of it, we may have broken out and heading into a stage 2 advance. That could still be early days. Same deal with one of my top 10 ETF picks this year, the Sprott Junior Gold Miners ETF, doing a momentum upward thrust signal today, breaking out on trend, and on the monthly chart, this too looks to have based, put in a stage 1 accumulation, and we could be potentially breaking out here. We've also got oil on the march higher, thanks to increased demand coming out of the States and China, the two biggest consumers of oil, not to mention rising Middle East tensions, as we may potentially see a response from Iran towards Israel over the weekend in revenge for Israel's earlier attack on the Iranian embassy in Syria, killing several military commanders. And there's a look at crude today. Higher highs, higher lows, actually getting up to $87.60 a barrel, and trend back in this market, holding ground above the resistance zone. And on the weekly chart, looks like we're putting in a higher high at the moment as well. So up until about a month ago, it's all been about AI, ripping chip stocks, Nvidia, Supermicro, spilled over into crypto, meme stocks. However, seemingly out of nowhere, commodities and energy just made their way to the forefront, significantly outperforming and a big rotation. And a lot of people are looking at gold and crude. However, how many people are talking about what the boom in artificial intelligence could do for energy usage? And in particular, one of my favorites, nuclear power, coming from uranium. And why it's a match made in heaven is because AI uses a ton of power to process huge amounts of data. And we can see that in this current and forecast for energy coming from IT. Currently, data centers currently going to use about 1.5% of the world's electricity. However, that segment is projected to grow faster than everything else and could actually explode to the upside as the world and everything in it becomes more powered by AI and the need to crunch enormous amounts of data every second. And that's why nuclear power is perfect for AI. It's very efficient, doesn't take up a lot of space, environmentally clean to please emission targets. It's not temperamental like solar is with the sun and wind energy. It's always on, easily stored, and if done correctly, is the safest and cleanest, most powerful form of energy out there. And that's why we've got who you could kind of say is the leader of this AI boom. That's OpenAI chief Sam Altman. The guy behind ChatGPT is backing a startup that's going to power data centers with nuclear energy. And we've got big tech just starting to dip their toes into this space as well, recognizing nuclear energy's incredible power to power their data centers going forward. And we already saw that just a couple of weeks ago with Amazon buying nuclear powered data center from Talon, and that's sitting right next to their data center in Pennsylvania. And so not only can big companies meet their clean energy targets and be net zero carbon like Amazon's trying to do by 2040, they also own more of their own supply chain, have more control and all the power they need to crunch huge amounts of data. We've also got Microsoft currently looking at next generation nuclear reactors to power its data centers and AI. We've seen that with them recently listing new job listings in this space, and we may actually see future data centers even have built-in nuclear reactors, in other words, become one in the same thing. With one data center operator saying a normal data center needs 32 megawatts of power flowing into the building. For an AI data center, it's 80 megawatts. And a long-time operator in the space, he said the industry has to find another source of power, and he reckons that is nuclear. And so my regular viewers know I've been bullish on uranium nuclear for years now, and ever since I started this channel last year, I've been talking about it. I've shared before popular ways anybody can get exposure to the industry. The most popular is the uranium ETF URA. It's been consolidating for a few months here. Still has a huge dividend yield of 5.5%. And just looking at the underlying commodity itself, doesn't actually trade on a futures exchange like most commodities do. The price is always negotiated between the producer and buyer. However, the only real way to get exposure to the actual underlying is through the Sprott Physical Uranium Trust listed on Canada's TSX. And there's a look at the weekly chart. Had a really good last year. Like I said, just been consolidating, pulling back for a few months here. And so they actually own uranium. And looking at listed stocks in the States, coming out of Baltimore, Constellation Energy, they're a big utility, 60 billion. They've been having quite the rip this year. Already up 68%. And they not only do nuclear, they also do hydro, wind and solar. There's also Vistra Corp. They're involved in the supply of clean energy, including nuclear. And they too, having a stellar Q1, almost doubling in price year to date. Another less known one that trades over the counter, Talon Energy. That's the company Amazon just bought a facility off, got a $5.5 billion market cap. They too having a great year, up about 53%. And looking at my fundamental indicators, they appear to be the best valued, with my fair value saying it's somewhere closer to $205 a share, more than double where we are today at 94. And one of my top 10 ETF picks this year was actually a uranium and nuclear energy ETF under ticker NLR. It's got a dividend yield of 4%, and that's much more diversified than the more popular URA. It's got over half of its assets just in Cameco and the Sprott Uranium Trust on TSX. This one's a bit more spread out around the world as well. 57% of assets in North America, 23% in Europe, and about 20% in Asia Pacific. And it's only small, 155 million assets under management, meaning the street has nowhere near got into this, and even the big popular one, like the Global X Uranium ETF, only has 3.2 billion assets under management, which isn't tiny. However, that's still less than half of what Cathie Wood has in just her ARC Innovation ETF at 7.28 billion. Just to give you some comparison to show that money big and small isn't really invested in uranium in a big way right now. And just looking at a long-term monthly chart, that's why I still think it has a lot of potential and room to run, as we did pretty much a decade-long base. And there's an old saying in technical analysis, the bigger the base, the bigger the space, as we often have symmetry. So this could potentially be the start of a 10-year bull market or longer. No doubt we'll have our retracements, pullbacks, consolidations that'll inevitably shake out a lot of people. However, there's really strong tailwinds for nuclear and uranium, with a strong fundamental reason being a huge supply and demand gap projected going forward. And this doesn't even really include projections. If AI usage explodes and all large companies start really doing what Amazon and Microsoft are doing and turning to securing their own supply of power via nuclear. Because of the Fukushima accident in 2011, the whole world politically kind of turned its back on uranium and nuclear. That's why we saw that huge decade-long base on the chart, and that caused a huge amount of underinvestment. And because these projects take years and years to come on board, that underinvestment in the prior 15 years leads to underproduction and supply for the next 10-15 years. While we've still got increasing demand, that's a huge structural tailwind for the price of uranium and uranium miners. And so often it pays just to keep it simple with making forecasts, especially in the commodity market, and hence why I'm going to stay bullish on this sector, likely for many more years to come. Moving on today, you may have heard about the drama with Tesla. Stock was actually trading down about 6% at one point in the morning after there was a media report that they're going to scrap their low-cost Model 2. Something the market's been hanging its hat on was speculation that instead of a Model 2, they may just be going all in on a robo-taxi instead. Elon said the article wasn't true. However, there may be some truth to it, because after the stock got whacked, Elon actually came on to Twitter with a very short tweet, Tesla robo-taxi unveiled on the 8th of August. And so just looking at a 15-minute chart, after we initially got that report, they were scrapping Model 2. We sold off hard, kind of held ground, and then Elon's tweet came out, and now we're trading back up 4% after hours. And what looks like Elon trying to save the reputation and image of his stock from getting damaged further. Already down about 34% year to date, significantly underperforming the market, and the rest of the Magnificent Seven today looks like he may have stood in and saved the day after all. We'll have to see where it trades next week, and we've got earnings coming from them in 18 days. Expectations that they'll have made 56 cents a share, and the market will be really looking for a beat here, considering the last two earnings missed expectations. And if he is able to pull off the robo-taxi, even just a good perception of its future promise, with Tesla owners potentially earning some revenue from allowing their cars to be used as robo-taxis, which then positions the car as more of an investment and should drive up its value. However, these are some big ifs. Just imagine not only the technological barriers to entry, but regulatory as well. I would say this is still likely years down the track. But what matters more is investor sentiment and perception. Moving on to crypto today, we got the SEC seeking public comment on spot Ethereum ETFs. They've started a 3-week comment period based on spot Ethereum ETF applications by Fidelity, Bitwise, and Grayscale. After they've already approved and launched spot Bitcoin ETFs, the natural next step is for Ethereum. I guess it would be surprising at this stage if they didn't go through. If they approve Bitcoin, they should approve Ethereum. And then who's to say we don't get more? Solana, maybe some other cryptos. Who knows? We may even see Dogecoin or Dog Whiff Hat turn into ETFs as well. As the government is still banging nails into the coffins of the previous crypto industry rulers. And what you could say, the third largest crypto king, after they took out Changpeng Zhao of Binance, Sam Bankman-Fried of FTX, they just cut down Do Kwon from Terraform. And just like the other crypto kings, they are guilty of crime. Do Kwon was behind the Terra USD stablecoin. Crash wiped out $40 billion in value, causing investors all around the world to lose a lot of money. He was actually on the run and was caught trying to escape with 10,000 Bitcoin and a cold storage device he had inserted into his lower region with a fake Costa Rican passport. And so it looks like he could be getting sent to the US to be convicted, even though he said he wants to serve time in his home country of South Korea instead. And there's a look at Bitcoin still holding its 50-day VWAP, while Ethereum has still lost its. And if Ethereum ETFs are going to come onto the market, that should be supportive of the price. However, that's still yet to be seen, but we'll know in a few weeks. Moving on to economic data, there's the jobs market prints we got today. Better than expected unemployment rate and huge beat on the non-farm payrolls. Next week, we don't have much to start the week, but Wednesday will be the big one. Headline inflation rate year over year expected to come in at 3.4%. That'll be really interesting to see what we get there. Back to the greed index, 61, and insiders just doing a touch more selling than buying here. And just diving back into the charts, I'll just give an update on some of the spreads I've been sharing with you guys over the last couple of weeks. The first one I want to talk about is what I call the long geopolitics spread, which I think is looking pretty good here. That's long aerospace and defense ETF, ITA, short airlines, jets ETF. Technically looks to have based. We are above the 50-day VWAP. We have been ranging for months now. However, markets don't stay ranging forever, and we're squeezing up a bit here, so we could be setting up for a breakout. And there's 3 reasons why I like this spread in times of rising geopolitical tensions like we have now in the Ukraine, Middle East, and potentially with China and Taiwan in months or years ahead of us. And that's because ITA, which holds stocks and defense companies, whenever we have rising geopolitical tensions, the prospect of more wars, it's all but guaranteed that taxpayer money is going to flow into these stocks at record clip like they already are. Not only that, but whenever we have global events, wars, pandemics, not many people want to hop on a plane and travel like we saw in COVID 2020. The airline jets ETF got smashed 65% in a little over a month. Not only that, but in times of rising war, that correlates with a rising price of crude oil like we saw in the 70s. And oil is the biggest variable cost input into airlines. And so even if people are still traveling, the price airline companies be paying for the oil goes up a lot, squeezes their margins, they have to charge customers more. And even though we've had a pretty good rise in the price of crude these last couple of months, airline jets have been hanging in there pretty good. However, I'd say the risk to the spread is to the upside and makes for a good hedge for further geopolitical tensions and potential wars. As much as we all don't want to see that, it's a potential way to protect one's wealth. Still got a bit of a pullback in clean energy happening, especially against the rise of traditional fossil fuels. It's more of a long-term idea, and clean energy is still yet to be seen whether it's formed a long-term base. We do have gold miners breaking out against gold the last couple of weeks, and one of the best performing spreads, long General Motors, short Tesla, worked pretty good today, not too far off highs, still in a trend. And another one I've been talking about the last couple of weeks, long Bitcoin in the form of the iShares Trust IBIT, short MicroStrategy. Had a really good day today, up 10%, as did long Nvidia, short Supermicro, and long cannabis, short tobacco, and silver versus gold looking close to breaking out as well. And just moving on to some other charts before I wrap it up, there's agricultural commodities touching on highs, with cocoa not ready to give up yet, and the price of your cup of joe in the morning about to go up. Just got the second momentum thrust upwards now. Got a bit of trend back in the market for coffee futures. More volatility in Trump media, down 12% today, with Reddit still holding ground there. Supermicro Computer, second consecutive day, closing underneath its 50-day VWAP for the first time this year. And the other big hot stock this year, MicroStrategy, down 11%, now flirting with its 50-day VWAP as well. And another March higher breakout, ExxonMobil. Like I said, it's been parabolic, walking the line. And just after I covered Root Insurance yesterday, it skyrocketed 16.8% today on a momentum thrust upwards. This is the hottest stock in the market right now percentage-wise, and not many people are talking about it. Momentum thrust up on the new GE Aerospace as well. Really strong technical price action, and the big banks kind of just hanging in there a little bit off highs. Alright guys, there we have it for the week. Actually finishing down, having a bit of a pullback underneath the hood in growth sectors. Even though we had a little bit of a bounce today, we've still got volatility, yields, oil, gold and energy green across the board, with the awesome move up in gold futures. Really strong technical price action here. Crude oil not too far behind it either. Whilst we've got weakness in bonds and volatility pushing up a little bit as well. Really hot jobs market. Economy is doing really well, and now we've got Fed Fund futures saying the Fed's no longer going to cut in June, and I'd say that's probably true, and the Fed knows that themselves. It's way too early to start cutting, and it's very possible we don't get any cuts this year. That doesn't mean it could derail the stock market. As I've showed you, we've got strong technical and election year seasonality at play. Just might mean a little bit more rotation out of long duration sensitive stuff like growth stocks, tech stocks, and potentially more into energy and commodities if we are going to see more inflation, along with demand picking back up as well. And it'll be interesting to see on Wednesday when we get inflation data, CPI, whether the recent moves up in commodities have made their way into inflation prints yet, or whether that could still be a little bit further down the track. Thanks very much for tuning in to the Click Capital Daily Market Review every day. Appreciate all your support, and you're welcome to leave your comments and thoughts underneath this video as I reply to everyone. Enjoy your weekend, and I'll see you guys on Monday night. Cheers.